love the fact that we're bringing back these no bombcast philosophies. It's
Yeah.
one of the things that I think sets us apart, that keeps us grounded both as a company and as well as communicating well with our clients. And I think it'd be great to jump into it,
Yeah.
um, focusing on a few things that are coming up from clients and questions that we're getting on a regular basis right now.
Yeah, that well, as you know, and as you brought it up, that's the reason why we do these is that um, having a forum to stay in front of all of you as clients and some of you that are not clients that are tuning in, to try our best, as we will today and as we have done in the past, to certainly we'll fielding some of the questions that people have written in for this particular episode. But really, like you said, Jim, it's an opportunity to try to address some of
Mhm.
the things that are currently on everybody's or some of us our minds with respect to the markets, the economy. And today, of course, we'll talk about, well, there's obviously, like every 4 years, there's the potential for a new administration and what that means, and so on and so forth. Before I get to the first question to ask you, one of the questions that you and I have gotten a lot is, well, hold on a second, particularly from people that don't know us, what's this whole business with the no bonds philosophy? What does that actually mean? Why is the podcast called the No Bonds Cast? And I mean, on the surface, simply put, it's a philosophy that we have that reflects first and foremost, our commitment to everybody that we're around to tell the unvarnished truth. And how that applies to bonds is that, well, for any long-term investor, which is all of our clients, investing in fixed income by and large, which is bonds, is a fixed rate of interest. And that does not align. It is not congruent in the long term with respect to fighting the threat that each and every one, anybody has if they're a long-term investor, which the first, guess would be, well, the market's going up and down. That actually is not a concern in terms of a long-term diversified investor. It's actually the fixed rate of interest and its lack of ability to not keep up with the cost of living changes as all of us experience over a long period of time. And so our no bonds philosophy seeks to highlight that for everyone all the time, to stay consistent and stay aware that each and every day, little by little, beneath the surface, we don't even realize it, the cost of our living, the cost of our lives, our lifestyles is going up. And your portfolio, long-term portfolio, has to be arranged in a way to reflect that. And that's what No Bonds is all about. And that's what we'll continually talk about essentially until kingdom come. Um,
Yeah, I love the name No Bonds Cast. I love the fact that we're very open with our philosophy on investing, and for us, it's about spreading that. It's about telling as many people as possible. The reason that we don't, as a company, invest in bonds, simplest put, is there's not one thing in our life that's fixed. So why would we ever want to invest in something that is fixed for an extended period of time? So
100%.
so that's why we continue to do these and spreading our word and telling as many people as possible, because this is different in the industry. And Ben and I and the entire company love talking about it. And the best way to spread it is bond, through social media as well as through podcasts.
Yeah, getting in front of people on a regular basis. Absolutely. So, in light of that, why don't we get started with the questions? The goal of these, as it has been in the past, is to keep things pretty concise. We did a little bit longer of an intro today just to talk about a few things, but we've got a few questions that some have been written in and some just come from us and our staff, of questions that they've gotten from some of you as clients, say over the last 2 or 3 months. So, first one is, and not a surprise to anybody, I'm sure, is, look, we've got a new administration
Mhm.
in power now, and like any new administration, there are a flurry of changes, and certainly the media certainly doesn't hesitate to opine on, depending on what media source that you're listening to, on the benefits of this change or how this particular change is going to end the world as we see it. So, Jim, I just wanted to, ask you, for the benefit of everybody
Mhm.
listening, is that, well, a question is often, hey, look, I'm hearing about all these changes. What kind of impact will or could that have on the short term as it applies to the markets of the portfolio and then the long term?
Yeah, I think that's the million-dollar question right now, right? Is where's that crystal ball and where is that leading us right now?
Mm,
And change for anyone in any situation is not easy. And when we're seeing a change literally as polarizing as an administration, right? It
right.
doesn't matter which way it is. People get nervous, people get jittery. There's a lot of concerns out there. And the
Mhm,
reality is, short term, we're going to see some volatility. We're seeing it right
mhm,
now. Investors are going to react to every single headline. They're going to react to a tweet. They're going to react to conversations they're having. And unfortunately, for a lot of people, it gets really emotional and they make emotional decisions in the short term, which, as Ben and I and our team talk about all the time, emotional investing is
mhm,
not what we're trying to do for any of our clients.
mhm,
So short term is very emotional. It's reacting to what people are seeing in the news and media. But
mhm,
honestly, that's exactly what we don't want clients focused on is these
mhm,
short term changes and really focusing on getting out of the noise, getting out of all of those little tweets and conversations that we might be having in the past and with our friends and family, and
yeah,
focusing more on what's the reality of the future.
yeah,
Stop looking short term, start looking a little bit long term, um, for really
mhm.
our own financial benefit. How do you see it playing out in the long term?
Well, I mean, just I'll comment first on what you said because I think that's really important to make sure we emphasize that is successful investing comes down to your temperament, right? It has very little to do with intellect. It has
Mm,
everything to do with your ability to make decisions along that journey that are relatively unemotional, right? Like you said, is that not getting caught up in the short term happenings of whether it's a administration, whether it's a pandemic, as difficult as those times are, those are instances where history has proven, with all the challenges that we've had, has proven that the long-term trend line is upward and it's relentlessly upward. So to your question, I absolutely agree with you in the short term. And then asking about the long term, um, you look at the going out 10, 15, 20 years plus, you don't really see, despite all the things that we've experienced over history of the last 100 or so years in the markets, you see positive, very, very positive returns mixed in with these very short term instances or scenarios where we have uh, discomfort, oftentimes discomfort that is very, very temporary, and then
mhm.
mixed in with some other times that it's a little bit more pronounced, right? It's a little bit deeper. You start to get this feeling like, hey, how far is this going to go down and for how long? However, things always recover and we move higher. And I think the long term question, Jim, I mean, we talk about it in our goals planning statement, right? Every one of our clients, eventually we execute a goals planning statement, which outlines their most cherished financial goals and objectives, um, creates then a blueprint for how we properly and efficiently achieve those goals and objectives. And then how do we fund that blueprint? How do we fund that plan? What types of investments? And really inside that goals planning statement, the real magic is the conversations that you and I have every day and our team has every day about, hey, what are the things that we don't know exactly what we're going to face in the future, right? Because the future is unknown and unknowable, but we know there are going to be more administrations changeovers in the future. We know there are going to be storms that are going to come along that we're not expecting. Yet, I know how boring it is, staying true to the philosophy, staying to the plan is what ultimately gets us there. And
Not
that's,
boring, not boring. How about the word disciplined? I
yeah,
think that's probably the better word of staying consistent and disciplined to a process that's focused on the long term. And whether it's an administration change or what's
yeah.
happening in the markets, focusing out into the future is the direction that we want to be looking at.
Absolutely. So that actually, you make me think of another question that we didn't get a write-in on, but certainly one that folks have been asking about is, um, we haven't seen or we haven't experienced in recently, call it in the last year or two, any kind of major downturn in the markets, right? And um, you have certainly a number of different ways folks ask that and kind of what they project from that. But the question generally that we get there is, well, what should we do given that it's been a couple years since we've had a major downturn? What should we do to anticipate or protect ourselves from the eventual downturn? I'm just wondering if you had kind of any scenarios or any insight on that question.
Yeah, I think that's a great question, and it's like you're waiting for the next, I don't know the best way to say it, shoe to
Hmm.
drop or the next
Hmm.
bad event to happen that's gonna turn the market sideways. And I think the first thing that we do a really good job of it with is talking about this, right?
Hmm.
When we sit down with the clients, it's not if the market is gonna correct,
Hmm.
we say when it corrects, right? Because it's
Right.
going to. History has showed us that the market is going to go through a correction. And I think
Yeah.
when we look at historical information on what the market goes through, and how frequently it happens, I would say that those types of corrections and those downturns are happening more frequently now than ever before. And there could
Yeah.
be a million reasons why. It could be technology that people have access to trading. I mean, there's a
Right.
million reasons why, but we're past the point when we're dealing and speaking with clients of saying that, well, it may happen. Well, the reality is we are
Right.
going to go through it,
Hmm.
right? We are going to go through it. I don't, again, have a crystal ball. I don't know
Yeah.
when it's going to happen. Um, but we want to be prepared. And I think
Yeah.
every time that we go through the market ups, we are always prepared and we're staying the course and we're staying disciplined to what we want to be focused on, which is the future and
Mm.
managing through those downturns through the future. But you do a really good job, Ben, explaining that and talking about not the if we go through a correction, but when. And as this approaches and as it happens, I think
Mm.
you do a really good job explaining that to clients. So why don't you kind of walk through what you say and how you address that?
Yeah, yeah, but one of the things you say is, using the term crystal ball, right? I mean, you're in good company with comments like that because folks like Warren Buffett, and the late Charlie Munger, his partner, and then virtually all of the well-known uber successful investors. One being, I wrote down a quote leading up to this of Peter Lynch, the legendary um, uh, portfolio manager from Fidelity, and he said, and I'm paraphrasing here: far more money has been lost by investors when they're trying to protect themselves or prepare for to anticipate these downturns rather than money lost during the downturns themselves. And I think that is a really one of the strongest statements that can be made about the process of being a successful investor. In other words, we spend so much, or we could spend so much time trying to anticipate or prepare for something that's very regular. It's extremely regular, and that's part of the conversations, as you're alluding to, Jim, that we have with folks, is that these are so damn regular and consistent to the tune of, we see a major downturn historically once every 5 or 6 years, where a
Mm,
third, the average downfall, however temporary it happens, however short-lived it is, it's about 30 to 33%. And it happens every 5 to 6 years, and then things recover. I think the challenge is that, as we're all human beings here, right? We tend to have pretty short memories, which is helpful in some ways.
mm,
But we also forget that however uncomfortable these previous experiences have been, they've been very temporary and we've moved on to higher highs. And where we get in trouble, and where any investor gets in trouble, is when you float over to that side of the spectrum, however unintentionally, for being a speculator versus an investor, right? So if, for example, in a scenario, you you're having a conversation and you're talking about, well, look, I know a new administration is going to come in. I want to move all my assets to cash and just to see
Mhm.
what happens to protect myself. History has shown that's a losing battle, as you opened up with earlier today, Jim, right? I mean, it is, again, to Peter Lynch's quote, trying to prepare to anticipate, but administrations come and go, pandemics come and they go, thankfully, and all these other different things. And this is the element of the conversation that we have with everybody. And to reinforce, we don't have the magic crystal ball, like you said. Our magic, our superpower as advisors, and having worked together for we'll be at 2 decades soon together, Jim, which is amazing. Um, our superpower is our ability to build resilience in our clients, to
Mhm.
continually talk and just have conversations like the ones that we're having now, to make sure that everybody understands and becomes. I don't anticipate. I don't have a nor do you have this expectation that folks are just going to be able to breeze through the next correction or downturn and not even think about it. I think that's unrealistic. But our commitment to our clients is to continually build resistance towards doing something that is going to be detrimental to their long-term financial health. And that's what we do.
So let me ask you this. So you just made the comment that, which I agree with, that every 5, 6 years we're seeing a major market correction, right?
Mhm,
And I think you used the stat of roughly 30%.
mhm,
And I'm in conversations like you and many people within our company with current clients and prospective clients that are saying, "Wait, hold on a second. I'm a retiree. Um, I don't want to go through that next downturn. I don't have time to recover from that." Um,
mhm,
this gets back into the emotional side, but also gets into the reality of investing and what actual
mhm.
long-term investing is. How do you answer that? What do you say to those people? Could be some current clients watching this. Is I don't know if I have the resilience to go through this again. What's your
Mm,
response to them?
yeah, I mean that first of all, that's a very valid and fair question, right? Because we're talking about a very big part of our client base, right? That are either um, very close to retiring or already fully retired and are now depending on the income to some extent from their portfolio to last the rest of their lives, but also to um, leave for whatever their secondary goals are for their finances. Secondary, not in terms of importance, but secondary just in terms of compared to retirement income. Well, I guess my first answer is, as you do, I know well, is empathize with that feeling, right? With that emotion. It's is perfectly natural and understood that, well, geez, these downturns, while they're uncomfortable in my, years ago when I was working, right? Um,
Right.
they don't have the same meaning to me as they didn't have the same meaning as they do now. And that's an important distinction, right? Because now it's like, oh, geez, this is now my income. My portfolio is now my income. Making sure that folks know that you and I understand and empathize with, yeah, that's a very valid feeling. You wouldn't be a human being if you weren't feeling that way to some extent. Um, the way we address that, we try to address that properly is, well, first of all, um, again, it is not, as we said before, for any long-term investor, which a 62-year-old, 70-year-old, are going to live quite a while, and they've got goals aside from retirement income, but also to benefit their extended family, future generations. The first and most important and detrimental threat is not the occasional downturn that you were talking about, Jim, right? It's the threat of our cost of living going up over time. So you have to, it is necessary to expose your portfolio in a very diversified manner to investments that have the ability to achieve long-term returns higher than that of the detrimental effects of inflation. Again, why is the name of our podcast called the No Bonds Cast? That's why
That's
first,
it.
yeah, that's why first and foremost. But two, to take it a step further is okay, but again, understanding that, what else can we do? And one of the things that we make available, as you know, to all of our clients who have perhaps a preference or just a little bit more of a emotional response to the possibility of a downturn and whether or not they that will affect their future retirement income. What we do in preparation for that is offer the opportunity to set aside an amount of cash in a money market for them. So for example, we plan for, through our goals planning statement, to set aside anywhere from, depending on our clients' preferences, anywhere from 12 to 24 months of living expenses aside in a high yielding money market. So what does that do? Is it, well, that provides first and foremost an emotional buffer for
Mhm.
them so that it limits or builds resilience, like we were talking about, in that feeling of, oh, we're going through a downturn, I'm in retirement, I've got to do something different with my portfolio. Well, this creates the opportunity to say, all right, well, I've got 18 months or 2 years worth of my expenses sitting in cash outside of the portfolio. And that doesn't prevent the portfolio from going down, right? But what it does, it allows the portfolio to recover, since these are temporary downturns, they have all been temporary. It allows the recovery to be unencumbered by withdrawals because you can use that cash safety net to supplement your lifestyle while we're going through this little downturn. Not ultimately necessary to have, but if it creates a buffer and helps clients through emotionally these downturns, that's what we put in place for folks. And these are the types of conversations we have.
Perfect. Totally makes sense. And I think that absolutely
Mm,
goes back to and answering the question of those clients, prospective clients, do
yeah.
they have the bandwidth to go through one of these types of corrections, not if, but really when it happens. So
Yeah.
really good explanation there.
Yeah, awesome. All right, so we're already over time, but I want to squeak in one more question for you because it is one that a lot of people are asking about. It's connected to the new administration. If you can, like, talk briefly about tariffs,
Mm,
that's obviously a buzzword that's been talked about a lot. How they might impact the economy, and then I guess that my question is, are they really as bad ultimately for us as investors, right, in the broader market as, again, depending on the news source, they're made out to be?
yeah, I think this is a tricky one, right?
Mm,
Because this gets a little bit even into the stock market, right? Short term versus long term, and what are we trying to do, and who are we trying to protect?
mm,
The idea of tariffs is they're meant to protect, in essence, we're in the United States, and protect our domestic industries. That's the
mhm,
long-term goal here, right? Is we want to protect our industry so that we have a strong job that we're buying here within the United States, and making it a little harder to get things from other countries brought in when we want to be supporting here in the U.S.
mhm,
The flip side of that is the consumer, you and I, our clients.
mhm,
Prices could get potentially driven up, and by how high? That's a little bit of the unknown,
mhm,
right? So when we're thinking about tariffs, I also look at this as long-term versus short-term effects
mhm,
that they could have within the United States. Short-term, right?
mhm,
Could will potentially drive up prices. Things get a little bit more expensive, even when it's put into the news or into social media that we're going to be putting a new tariff, we meaning the United States, on another country. There
right.
is an immediate emotional reaction to what that means right in the stock market without anything changing immediately. So they get
Mhm,
really, really tricky with how things are going to be affected. The idea of
mhm,
tariffs in the long term is to protect the United States economy. That
right.
is the idea of what we're trying to do. On the
Yeah.
flip side of that, it could hurt in the short term.
Yeah.
It could make things a little bit uncomfortable, but the long-term goal of the tariffs is what I think anybody, whatever side of the political aisle that you're sitting on today, should
Mhm,
be focused on is why are we doing this? Does it hurt temporarily? Does it hurt long term? How is
Mhm.
that going to affect us over time? And that's really, really hard to do because I think all of us see the news, see the media, and we already instantly have an emotional opinion on what's going on.
Yeah.
So tariffs, like I've said now twice,
Yeah.
get a little tricky. They
Yeah.
get hard, they get uncomfortable. But again, going back to how you explain things, getting into a little bit more in depth here in the next few minutes, can you talk about that short-term impact consumers as well as industry, and then quickly turn that over into the long term on that same questions, industry and consumers?
Yeah, I can be really brief there too. I mean, the theme that keeps coming up as you talk, right? And I think it's the correct one. Certainly is short term versus long
Yeah.
term, and what potential disruption, whether it's a tariff, whether it's a global unrest in terms of, for example, I remember back in 2022 when Russia invaded Ukraine, or one of the many other disruptions that we've seen, which have been countless over history, right? It comes down to the fundamental question of, okay, short-term impact versus long-term impact. And
Mhm.
what the data, what the reality has shown is that, yeah, there's plenty of things that disrupt or potentially disrupt the economy in the short term. But then you look at a little bit more of the long term, and however bad something was um, projected to be in the moment, the first thing that comes to my mind as we're talking right here is, remember the Ebola scare,
Oh, yeah.
15 years ago or so, where the markets in the short term really reacted. And
Mhm.
then it just floated out of news. It obviously just wasn't, and it just wasn't a thing anymore. And so I guess the takeaway, just to keep things concise, is try your best, however impossible it is to completely remove it. Try your best not to get worked up about things in the short term.
Mhm.
Talk them out, right? Try not to make rash decisions based upon something reported in the media, because everything that we've experienced ever has, whether it's impacted the short term or not, the longer term picture has been fantastic. Nothing
Mhm.
short of fantastic. And it doesn't matter what age you are. It matters to the appropriateness of how your portfolio is allocated. We talk about, the cash balance and the safety net we set up for folks. So have that conversation. If you're a client listening right now and these things are on your mind, reach out. We'll set up a time to talk, and continue to have these conversations and make sure that we reemphasize the tenets of the goals planning statement as well, that serve as a foundation for everything that we do with you as an individual. So I don't know if you have any follow-up comments, because I could, certainly wrap this up now and talk about briefly the next one.
Yeah, I think that just to kind of wrap things up here is staying
Yeah.
disciplined to the plan. Ben and I and our team, I loved how you used the word and continue to use the word, the unvarnished truth, no matter how uncomfortable it gets. That's what you can expect, and that's what you're going to continue to get from Beck Bode as a company as well. That discipline, that unvarnished truth, and that plan and process.
Mhm. Fantastic. Well, appreciate everybody. For those of you that are tuning in live today, and those of you that sent in questions,
Mhm.
and otherwise, folks, this will be sent out via email for replay. So you can watch this as you have been able to watch any of the other ones on your own time. Feel free, no matter when you're watching it, if you want to fire questions in, send us an email, so on and so forth. Bits and pieces of the No Bonds Cast will be spread amongst social media eventually. So you'll see bits and clips there and access to watch those. And then this is the format, certainly for clients specifically like you, where we're going to be having these every 2 weeks, featuring different members of our staff and then guests from the outside eventually, to talk about things that hopefully you find interesting. But until then, I want to thank Jim. Thanks for jumping on with me this morning. Thank you to everybody watching, or if you're watching the replay. Appreciate it. Reach out to us, and I hope everybody has a great day and a great week.
Thanks, everyone. Have a great week.